Hello and welcome back. We're going to talk about Dr. Reddy's Laboratories, and this is a company that was suggested by one of our subscribers. It appears to be a pharmaceutical, a company that had its IPO back in 2006. It's an Indian company, and I wasn't aware of the company really, but I took a look at the stock news because it really helps me identify what is happening with the company. So this is the stock news for the company, and so you'll see that this is mentioning cannabis stocks here. And this means that Dr. Reddy's does handle cannabis, I'm assuming, because of this news species here. And you will see that these stocks actually supposedly went wild this week, and that includes this stock, Dr. Reddy's. And I'm assuming this is why the subscriber actually suggested to take a look at the stock. Now, we will do our normal analysis here because it's not about the news and it's not about the trends, it's about the company. And so we're gonna take a look at our stock analysis module here. You will see that in March 7 the stock was down quite a lot, coming down from a downtrend, and now it's having an uptrend, and this is why I guess the news pieces we're talking about the stock going wild. And if we take a look at the 6-month period, you kind of notice that the company was at 72 over here, and the whole period, the whole time, the company has been a thing here for the last 5 years. That is really. We will see that it used to be 41, and now it's sitting at 55. So it hasn't achieved much growth in the last 5 years, but at least it's not down. Now in the last year it has been down 26%. So knowing all this, let's take a look at the key metrics of the company. The P ratio is slightly elevated. It's 26.8. It used to be higher, so it's probable that the stock price went down and actually brought down the P ratio as well with it. And the price to free cash flow ratio is pretty elevated here. It is positive at least. It used to be negative in 2017, so the company was losing money, but at least now it's actually positive. It's rising though, and that's not a good thing. Now the outstanding shares are about the same really. This is an X, but practically speaking they're about the same. There's a very small difference here, so I wouldn't think that is a problem. The 5-year revenue growth is pretty low here. Now it went from 2.1 billion to 2.5 billion. That's 5 years. That's not a lot of revenue growth, as you can understand. And the same thing with net income growth and free cash flow growth, which is the best. But that can be a little bit deceiving, because with this kind of net income growth, getting this kind of free cash flow growth probably means that there was some means of actually circumventing the net income that the company is generating, and actually making free cash flow, maybe from some entries like cash compensation, stock-based compensation, or depreciation and things of that sort. We'll take a look and discover why the discrepancy here. You typically don't want this insane discrepancy, because if the company is making that much free cash flow, where does it come from? If they don't have enough net income, because net income is profit, and free cash flow is operating activities minus capital expenditure. So where does this cash flow come from? So the next things here, we can always take a look at the returns. These are fairly typical, nothing to be cautious about. And good debt. It looks like the company doesn't seem to be having a lot of debt. Now a dividend yield of 0.6% and a payout ratio of 15% is rather elevated. This means that if the dividend yield was 1.8, this would be about 50% here. So that is interesting. I mean, it looks like the company is paying quite a lot compared to their net earnings, but it's not a lot compared to the dividends, to the net income, this specific yield. So it's worth noting though, it's worth knowing what the company is actually paying. So I wouldn't look at this company for the dividend. In fact, it may actually be even a better idea to completely slash it, I don't know. So the next thing that I want to be taking a look at is the financial statements here. And we can take a look at the income statement, and you'll see this kind of growth that we were talking about. There's very limited growth for the company. At least it's positive, but it's limited. And the net income of the company is increasing, but rather marginally. And actually this year was actually worse than the last year. Very close though, very similar. Now the company, and we can actually take a look at it, is actually having a $9.3 billion market cap. So it's not a massive company, but it's not a small company either, so you'd probably expect it to do a little bit better for this kind of market cap. But the next thing I'm going to examine is the balance sheet, and let's see what the company's assets are doing here. And the total liabilities of the company are increasing, but the total equity is increasing as well. And so with the total assets here being more than the liabilities, that's a good thing. The company's total equity is increasing normally, and additional paid-in capital is not that much because the company hasn't been issuing many shares. But what is important and what is very interesting to me is the cash flow statement here. I really want to understand why this company is making all this free cash flow, because the free cash flow has a discrepancy compared to the net income. It's more than the net income here, as you can see, and the growth is much more than the net income. So we will see here that we have entries like depreciation and amortization, which is not a cash expense, and this is why it's added back to the cash flow statement. This heavily skews the results here of the net income provided by operating activities because of this. So this other non-cash item also, there is a little bit of extras coming in from this one. The practical net income is this line over here, and the capital expenditure is this line. So this is a little bit elevated artificially, and especially from the depreciation and amortization, as you can see. And this is why in the stock evaluation tool, we are using formulas that actually take into account both of these factors. And so we take into account the revenue, the net income, and the free cash flow. And we're using margins, which are basically the net income margin is the net income divided by revenue, and the free cash flow margin is free cash flow divided by net income. And so we do have a way to combine these three different metrics so that they make sense, because you don't want to be making free cash flow without making net income. It doesn't make sense for a company. It's artificial. So the revenue growth of the company that we're going to be using here, we're probably going to go something like 5, 6, and 7 here. We're a little bit constricted here because we have a very, very small, pretty much, revenue growth percentage over the years. And so we kind of want to be a little bit conservative. We cannot go overboard. So 5, 6, and 7, I think, makes sense. The net income of the company is going to be... as you can see here, they had some negative years, but the margins are about 8, 9, and 10, I'd say. So this would make sense, 8, 9, and 10. It's about what they are doing pretty much every year. Free cash flow margin, now over here, we'll have 2 years that were a little bit odd, but typically I think we want to be a little bit conservative here as well. So let's go 80, 90, and 100. And an annual return, we're going to be using 13 because we can get 10 from an ETF, so an S&P 500 ETF, so we need to be making more out of a single stock. Now, if we hit calculate, you'll see that we are way above even our highest estimates here, even our high estimates. And so the current price of the stock is pointing to a company that is overpriced, it's overvalued, based on what they are doing financially. And this is why I would avoid right now. Now, it's not a bad company. It doesn't look like it's a bad company, but it looks like it's overpriced for what it is, to my eyes. I mean, that's what I see here from the company. And the fact that their net income is not that great, and they are actually making more free cash flow, is a little bit of a deterrence as well. Again, remember that their net income is practically the same every year. It's not growing, yet their free cash flow has been growing, again, a little bit artificially. You'll see the growth here is a little bit insane, because of these extras, because of this extra depreciation and amortization, these lines basically, which are non-cash items, they are added back to the free cash flow statement. So that's what I wanted to talk about in this video. I hope you enjoyed it and you liked it. Please leave a like if you did, and subscribe if you're not a subscriber. Moving on with the tool, I'm creating more and more, and it's about ready to get released, probably, as I said, maybe less than 2 months. I'm still adding things, and I still want to be doing some other things in the stock evaluation, in the stock analysis tool for the most part. There's more to be added here, more metrics. This is coming next, but I think in a couple of months we'll be ready to go. So that would be great. If you did like this video, again, please leave a like, and also take a look at this one that I made earlier. It's about Tilray. It's another similar company, sort of, and so you may enjoy watching this one as well. Thanks for watching this specific video, and hope you continue your watching and you're gonna enjoy the next one. See you soon. Bye bye.